or deny, the legitimacy of this rally. Before we do, just a quick note here that the unemployment claims numbers were expected at 213,000 and came back at 207,000. And you can see here that it's fallen over from our last April 4th record of initial claims. But the 4-week average is moving higher here, 1, 2, 2, 4-week period, 8-week period total in a row. So we have 1, 2, 3 off of our low initial claims are rising. But back to that idea of our leading indicators. We have really 5 different leading indicators that you can make a case for right now. We have the crude oil market, which when it is falling, the Fed rate cuts get pulled into the future. And we just think about that as just the Fed fund futures influencing the market or the market's perception of rate cuts in the future. And the question is this, is now that the indices are back at their all-time highs, okay, what were the Fed fund futures when we were at our previous all-time highs? Well, they were pricing in a rate cut in June of this year, 2 months away, right? Where are they priced in now? September of 2027. So is this rally supported by the perception of rate cuts being pulled into the future? The answer is no, it is not. What is another leading indicator for our markets? There is the dollar. And when you're looking at the dollar, we'll just look at this on a 12-hour time frame instead of a daily. The indices and the dollar are inversely correlated, almost by 0.90 right now, negative 0.9. The question is the dollar making new lows of the year to support this rally on the indices? And the answer is no. The dollar has actually made it into its second full 50% retracement long from lows of the year to highs of the year. Last time we were inside of this pullback, we put in a top on the indices. That was the end of January, the beginning of February. So on the intraday time frame, we can't confirm the support level yet. It would take the break of a 61.8% line here at the 98,667. But this rally is not supported by the dollar. Bank is the classic, one of the classic rules that we have is that, if you see a rally without the financials, you can't trust the rally. Are the financials making new highs of the year? Far from it. In fact, the financials aren't even making new highs and breaking out of last week's highs. We haven't even broken through last week, Thursday's highs. So is the rally supported inside of the financials? The answer is no, they are not. And then there's the VIX. The VIX is still sitting here. It's actually amazing. There's quite a few divergences. Over the longer term, the question is the VIX in its continuous contract making new lows of the year? And the answer is no, it is not. What about in the intraday timeframes? Is the VIX making new lows of the week in the intraday timeframes? And the answer is no, it is not. The VIX hasn't made new lows in its new May contract since Tuesday. Tuesday at about 7:45 in the morning, we put these lows in on the VIX. In the indices from that same period, and we were doing the math on this, the indices have rallied from that Tuesday time frame and have put on. This stream continues at emoneyaddict.com. The link is in the description. Join me there for tools and resources for learning measured move trading. I wrote the book on the measured move. Check out the hundreds of others that have learned trading plan development, pattern recognition, money management, and trading discipline with me to become the best, most confident trader that you can be.